Good evening, everyone. Welcome, and thank you so much for joining us today. My name is Carla Rodriguez, and I am a Business Development Officer for LAPFCU. I'm thrilled to have the opportunity to connect with you all during this important webinar about budgeting. Tonight, we're going to dive into some tips on how to spend, save, borrow, and plan for future expenses, needs, and wants. Before we get started, I want to mention this live webinar will be recorded, so you should receive a recording by tomorrow to rewatch and share with your friends and family. We invite you to enter your questions in the Q&A box and we will answer them towards the end of the webinar. Our speaker is Colleen Garrity from our financial education partner, Balance. Colleen has been in financial industry for over 35 years, helping others understand how to improve your financial well-being. Let's get started. Take it away, Colleen.
Why, thank you very much, Carla. I'm really happy to be here with all of you. And this is going to be fun. I really actually enjoy this one because this one really helps us to really see where we are and basically being in control of our money versus our money being in control of us. And I always love to say that, okay? As Carla did mention, there is a handout as well. She mentioned the question box, but there's a handout. There's a little piece of paper that has a little paper clip on it. So go ahead and download. There's two handouts for you. One to really help you with your budgeting, and the other one that goes along with what we're talking about today, as far as are you financially healthy. But I do actually have a question for you before we do get started. So let's see how you guys feel about this. How do you feel about talking about money? Kind of want to know where my audience is at. All right, guys, I'm going to go ahead and end the poll now in 3, 2, 1 and share the results. So actually, it's really interesting. 50% of you don't love it, but you're here, which is really a good thing. And 50% of you love it and you're comfortable when it comes to finances. I love the fact that none of you are avoiding it at no cost. So that's really good. I'm really glad to see that. That's a good thing. So let's go ahead and get ourselves started. But before we do, we really need to understand what is financial health, right? So what actually is financial health? So let me go ahead and share one more poll with you. And that is, what do you think financial health is? What do you can answer as many of them as you want to. There's not one answer, so there's more than one. You can answer more than one answer here. What do you think financial health is? Okay. You guys are doing good. We got about half of you answered. Let's see if we get the rest of you to answer. Okay. We're getting there. I'm going to go ahead and close the poll in 3, 2, 1, and I'm going to share the results with you. Okay, so it looks like kind of even Steven with having credit scores over 780 and checking it monthly, putting money into savings account and knowing where your money is going. I'm glad none of you said making a large paycheck because that's true. It's true that that's not one of them. So basically, when it comes to understanding what really means to be financially healthy, which is so much more than having a good credit score. While there are a lot of ways, to check your credit score, it's only really one piece of the equation. And having a 780 is great. However, guess what? It's not really being financially healthy. You just want to be in the good range. As long as you're in the good range, that's really all that's important. And you really don't need to watch your score monthly, okay? Making a large paycheck, like I said, that's great. It makes you feel good, right, in some senses, but it's not a key to financial health. Same with owning a home, which I'm glad none of you answered that one either. That's just a preference. Now, you do want to put money into savings, and you want to know where your money is going. These are two of the components of being financially healthy. So basically, being in control of your money again, instead of your money being in control of you, is what is really the important thing. Okay, let's close the poll. Okay, so now the core aspects of financial health do include these: the knowledge of resources that will help fund education and living expenses, doing research when buying a home, or if you're getting a loan, or maybe a scholarship or a grant. Anything anything that you're looking for, you really want to research it, right? The good news is, of course, in today's society, we have easy access to really research everything we want to, right? But you really want to make sure it's a reliable site. Don't go to sites if they're not reliable. Everything you see on the internet is not always true, okay? Going to LAPFCU and talking to them about different options that you may have is a really good step in order to get that knowledge, right? Going to webinars like this one really helps bring in knowledge, because you know what? Knowledge is power. Now, the second bullet, the ability to maintain a balanced budget, by a raise of hands, who keeps a monthly budget? So who actually keeps a monthly budget? Raise your hand if you keep a monthly budget. Okay. All right. I see some hands going up. That's great. All right. So I'm going to go ahead and lower those hands. That's really good. That is really what you want to do. It's knowing where your money is going, and putting your money into savings, again, is very important. Instead of using that B word, budget, right? That's always a scary word for a lot of people. Call it a spending and savings plan. It's more relaxed, right? This, of course, leads me to the final bullet on the slide: being prepared for all expenses. If you, again, are in control of your money with a good spending and savings plan, then you will be prepared for any short-term, long-term expenses and emergencies as well, okay? So another poll question for you, and that is, does financial health impact your physical health? What do you think? Yes, no, maybe not sure? What do you think? You guys answered that quickly. Thank you. We got half of you answering. See if we can get a few more of you. All right. I love the fact that you guys did that. That's really good. Okay, I'm going to close the poll in 3, 2, 1 and share it. And I'm so glad you guys said that. You are correct. Financial health does impact your physical health. In fact, as this slide says, 65% of Americans are not financially healthy. Again, this is according to the Financial Health Network. That's over 214 million people, okay? The majority of the country, regardless of income, actually could not come up with $600 in the event of an emergency. Money does not really buy happiness, but studies show it can impact your physical and your mental well-being. As my grandma always says, money is not the key to happiness, but it's dang inconvenient without it. I'll never forget that saying. She said it to me all the time throughout her life, right? Now, 6 in 10 adults, according to the American Psychology Association, the APA, mention that money is a main stress factor for them, okay? Now, signs of financial stress, and you want to think about it, or any of these kind of relate to you, right? Worrying and feeling anxious about money. Arguing with loved ones about money. Feeling guilty when you spend money on non-essential items. Being afraid to answer the phone or open your mail. I've been there. If you are in the constant concern about paying bills or saving for retirement, this will put you at risk. And these are the things that can actually happen to you physically, are things like anxiety and depression, digestive problems, headaches, heart disease, sleep problems, weight gain, memory and concentration impairment. So these are some things that the psychology, the APA, my APA came out with, that these are actual real things that happen to you. I mean, I know I've been to the doctor in the past and they said, oh, it's stress. I don't think so, right? Well, stress can actually physically harm you. So you really want to kind of be in control of that money, right? It does a world of hurt to your body. Okay. And financial stress, by the way, is the number one reason why people feel ongoing stress. Now, according to the Financial Health Network, there are four core components of financial health: spend, save, borrow, and plan. And we're going to cover all of these. And we're going to see where you're at as well. We're going to actually do a little quiz here in a few minutes. And I want you to answer them honestly when you do, okay? Because it's really going to help to see where am I when it comes to financial health, okay? So we're going to go ahead and ask these questions. Now, you're going to find the questions in the handout I mentioned. However, I will be sharing the questions. So please feel free to just answer on a piece of paper if you didn't get the download. Go get yourself a pencil and a piece of paper, okay? Now, there's only 10 questions, and I'll be sharing them with you in a few seconds, and I want, again, for you to answer them honestly. Now, if you have a significant other with you, both of you can answer separately, or if you really want to answer together, you can, but it's kind of fun to answer separately. Now, you're going to write down the number under the answer for each question. There's going to be a number there, 1 through 5, okay? At the end, I want you to total up the numbers, whatever your total is, and you're going to times it by 2, okay? So here we go. Are you ready, Carla?
I'm ready.
Okay.
Over the past year, how would you describe your spending patterns related to income and expenses?
Okay. Question 2. Over the past year, which of the following statements best describe how well your household is keeping up with your bills and credit card payments? Again, you write the number under the score section, whatever number comes up, that's where you want to answer. That's the number.
Okay, number 3. How many months would you be able to live off your savings? Exclude savings that are set aside in retirement accounts or the sale of assets. Consider basic monthly expenses such as housing, food, taxes, and healthcare.
Number 4, consider a long-term financial goal you may have, like buying a home, starting a business, retirement. How confident are you that you could reach these goals in the time frame that you hope to achieve them?
Number 5. As of today, how would you describe the debt your household currently has? Please consider money owed on the bank loans, student loans, mortgages, medical debt, past due utilities, etc. Money owed to friends and family and any credit card balances you carried over the previous month.
Number 6, what percentage of your monthly income goes to your debt payment? Again, consider money owed on bank loans, mortgages, student loans, medical debt, past due utilities, and so forth. Money owed to friends and family, and any credit card balances you carry over from the previous month.
We're almost there. We're almost there. Number 7. Do you take steps to maintain or improve your credit score?
Number 8, how far in advance does your household plan for upcoming financial obligations or opportunities? For example, annual bills. Annual bills would be like your car registration, right? Life events such as weddings, large purchases, and so forth.
Number 9, how confident are you that the insurance policies your household owns will provide you with enough support in case of an emergency? Please consider your health insurance, home rental insurance, life insurance, and disability insurance.
And the last one, number 10, how possible would it be for your household to come up with $3,000 in the next month to deal with an emergency? Okay, now it's time to add up those scores. So what I want you to do is add up the total for the 10 questions, add them up, and then you want to times it by 2. So if your answer is 35, you want to put 70. If your answer is 20, you want to put 40, and so forth. So take your total and times it by 2, and I'll give you a second to do so. Okay, if you have your total, give me a little emoji or raise your hand so I know that you've gotten it added up. Anybody want to give me an emoji on how they feel about it? Or raise your hand. Okay, I got some hands going up. Thank you. All right. Okay, looks good. Okay, let's go ahead and move on so you can see what your score means, okay? So let's get to the next one. Thank you very much, Jean. Thank you. All right, guys. Good job. Okay. So I want you to review the scale on the slide. And we're going to discuss, the ratings and how to improve your score. I've never seen anyone who's had 100. So if you have 100, I am applauding you right now because I've never seen anyone have 100%, okay? If your score happens to be over 60, you're actually considered more on the healthy side. But again, if 100 is really, you still need to improve because probably don't have 100, right? If your score is under 60, I don't want you to worry. You really can improve and you're in the right place right now. And now is the time to start to take control of your money instead of course, your money taking control of you, okay? Now we're going to talk about each of these components, spend, save, borrow, and plan, and how you can improve that score. Let's get started with spend first, okay? When it comes to spending, you really want to follow the golden rule of finances, which is, of course, never spend more than your income. Remember, your credit cards are not income, okay? To do this, it really is time to create a budget, or rather a spending and savings plan. It might help to determine what is important and what you can cut or lessen, right? This is also going to help you to get a handle on all your bills and determine where your money is going. It's going to show where you can cut expenses. For instance, you may, for instance, spend money at the gym, which I did, okay? I was spending money at the gym and never going to the gym. I was taking walks, but never going to the gym. And I was spending money every single month. Why? I was throwing, even though it was only $12, it was still throwing money away, right? So you first want to really start by reviewing all of your bills, all of your statements. Where is your money going, right? You also want to track where you're spending your money as well for those little items, things like $1 at a vending machine. Where is your money going? My mama always told me that you really know to where every penny is going because a penny may save your life someday. Now, you'd be surprised at how, that coffee or fast food or even that streaming station or games, how they add up. For instance, if you go out to lunch daily, right? I used to go out to lunch every single work day. I'd go to work and during lunch, I'd go out and get something to eat. I spent an average of $12 a day, right? So if I'm looking at that, 12 times 5 days a week is $60 per week. What can I do with $60? And if I times that by 52 weeks in a year, I'm spending over $3,000 going out to eat. So monthly, I'm spending $260 per month. And you can kind of calculate that on anything that you happen to have a habit of doing a lot of, that you want to see where maybe if I don't go out as often, right? So what I started doing was I started bringing my lunch. So I was spending between $2 to $5 per day instead. I was saving like $150 each month. And every once in a while, I still would go out to lunch, but I wouldn't make it a habit of doing it every single day. Now, once you again know where your money is spent, you can create a really good spending plan, budget, right? You can use a spreadsheet, you can use pen paper, and of course, there's always an app for that, right? Now, once you have your spending plan in place, now it's time to get those bills caught up as well. Now it's time to get your bills caught up. Now, one of the handouts that I did give for you is the money planner, okay? And it's a really great handout for you to really plan a great budget or spending and savings plan. It's got all the components in there, and if you follow it, you're going to get yourself in a really good budget. But what about the bills, right? What about that debt that you have, right? We have to get those bills caught up. What you want to do is if you are behind on your bills, don't bury your head in the sand, right? Call and make arrangements with your creditors to bring them current. I'm not really going to talk a lot about debt because we're going to talk about that a little bit more, but I'm talking about the late payments, on your electricity or your water, things like that. You want to work to get your bills caught up, even if it means cutting things temporarily that you enjoy until you can get current. You can also ask for an extension or a deferment or maybe a payment plan for that particular bill. Many creditors will work with you, but you have to call them, okay? That's the main thing. Have yourself prepared for it, what you can afford, call them up and talk to them. They will listen. Next, we're going to talk about savings, okay? Now, you should really save. It should always be part of your spending and savings plan. As you see, spending and savings plan, right? Savings is even in that, right? You may think that you have to save a lot, but starting to even put in just like $10 a month or even $1 is good, right? That's a positive step towards building a savings. You can start by building an emergency savings account and a long-term goals like retirement. That's where you really want to kind of concentrate your savings on to begin with. Now, one thing I always do is I have actually $25 from my paycheck automatically deposited into my savings account each month. And you can do that too. Just go to your HR and instead of your full paycheck going into your checking, have a small amount go into your savings account. If you don't see it, you may not spend it, okay? And if you get a raise or a bonus or some unexpected money, toss some of that into savings. Make it a habit of, okay, I got this raise, so I'm going to put this percentage into my savings. Or I got this bonus, so half of it's going into savings. Make it a habit of putting money into savings. Once it becomes a habit, you will find it easy and you really won't miss it. It takes 32 days to build a positive habit or break a negative habit. So really be kind to yourself, okay? Remember, you are an important asset. And when I'm talking about an emergency savings account, like I mentioned, you really should have 3 to 6 months worth of essential living expenses. Essential living expenses are things like the roof over your head, food and not fast food, your utilities, your car if it gets you to and from. Nowadays, they even say the smartphones, okay? Because that's something that becomes essential for us, okay? Of course, education, if you're sending your kids to college, that's considered essential, okay? So things essential that you need to live on. Those are the essential things. And you need at least 3 to 6 months worth of savings for that. So start building it. Build it slowly if you don't have one, okay? And you can do it. I know you can. Next, we're going to talk a little bit about borrowing. This leads us to it. Borrowing, is it good? Is it bad? Can you raise your hand if you think borrowing money is a good thing? Or give me an emoji. If you think it's a good thing, raise that hand. Okay, got a couple hands going up saying it's good. Okay. All right, now what about bad? Raise your hand if you think borrowing money is a bad thing. Less hands going up. Okay. All right, thank you. Thank you for being so honest. Okay, there's another one. Thank you, Anna. Okay. Well, borrowing actually can be good or bad. It just depends on how you're borrowing, okay? For instance, if the value of what you are borrowing is going to go up, like a house or education, because when you go to school and get a higher education, you usually get paid more, right? So that's values going up. These are considered good debts. Now, having things like credit card debt can be considered bad if you're carrying it over for several months or years, okay? So if you're taking your credit or your credit cards and you're using them and paying them off the same month because you budgeted for them, right? Then that's not such a bad thing. It's sort of in the middle. Depends what you're buying. So it all depends on how you're really borrowing that money. If you're being responsible, it's a good thing if it's raising your credit score, right? As a general rule, your total debt, excluding your mortgage, should be no more than 10 to 15% of your take-home pay. But I do like to follow the 50-30-20 rule, okay? The 50-30-20 rule. 50% is for essential living expenses, again, your housing, groceries, clothes, okay? 30% for unessential living, stuff like going out to eat, getting your nails done, those streaming stations, designer clothing, things like that. And 20% for savings. And this includes your retirement savings, okay? Now, the main point or meaning is when you're using your credit cards, it should already be budgeted. So you can pay them off each month and not carry that debt, okay? Because that becomes debt. Once it becomes debt, it's not so good, okay? Now, you may have heard people say, especially when you're borrowing money, your debt to income ratio, right? This is referring to your monthly debt payment divided by your gross monthly income. So that gross monthly income is before taxes. Now, the debt payment included in this calculation are your mortgage, your rent, in addition to all your other debt, such as your auto, personal loans, all that stuff, right? So you can actually figure out what my debt to income ratio is, okay? And it's really kind of a good idea to look at that. And that's called a DTI, by the way. If you hear a DTI, that's a debt to income ratio. Now, many lenders will allow you to have 43% as the highest DTI, but the average is actually 28 to 35%. So let me kind of show you what I mean by that. So if you want to calculate your debt to income ratio, your DTI, you want to take your monthly debt, and that means what you're paying out monthly, not what the total owing is on that credit card or on your debt, but what you pay monthly. And you want to divide that by your gross income. Okay, so if I had 2,257 was going to my monthly debt, and I divide it by my gross income, which is 6,247, this is an example, that's 36%. So I'm a little bit above the average of 28 to 35%, but I'm within the ballpark, right? At least under 43%, okay? So that's where you're going to calculate that. So you can actually calculate that yourself just to kind of get an idea of where it is. Now, raise your hand if you know your credit score. How many of you know your credit score? Raise your hand or an emoji. Okay. A couple people are raising their hand. Thank you very much. Appreciate that. Okay. Thank you for that. Okay. Now, having a prime credit score helps you to be financially healthy. But what really is a prime score, right? What is it? Well, a prime score is considered anything over 650. Super prime is over 750. And subprime is below 649. So you really want to have a 650 or above credit score to be really considered financially healthy. Okay, so you really want to kind of look at that. Now, you do need to give permission to have someone check your score, or if you've already given permission, like with your creditors, they can kind of look at it with a soft pull on whenever they want to. But the hard pulls, you have to give permission for that. But I do have another poll question for you, just to see if you know what is actually used in a health score. So why do you think credit is important? Do you need credit for these things? What do you need your credit for? Okay, we got a fourth of you have answered. We're getting up there. We're now halfway. Okay, now we're going more than half. Good. You guys are answering quicker. Okay, I'm going to go ahead and close the poll in 3, 2, 1, and share. Absolutely. I applaud you guys so much. You are absolutely correct. When it comes to credit, all of these apply. Employers want to verify you, right? And they really want to make sure that you're responsible. Insurance companies use credit to set your premiums, to be honest with you, right? Landlords want to make sure you're responsible. And of course, credit cards, again, that your good standings, right? So you've got all of them. So all of them are correct. Very good job, guys. Proud of you that you knew all that. That's really good. Okay, so what is a FICO score, right? A FICO score is the most common, and it's between 300 to 850. Most lenders will look at your FICO score. However, there are other scoring models out there. How many of you, by a raise of hands, um, go to one of these monitoring companies and have them monitor your credit for you, and you kind of get little updates that, oh, your score went up. Yay, your score is going down. Oh no, right? How many of you have a monitoring company that you have for your credit? Anybody want to raise? A couple people. Okay, thank you. A couple people are. All right, thank you. Okay, so yeah, there are monitoring companies out there, but what they do is sometimes when you go into get credit somewhere, right? You're going to apply for something and you get this wonderful score and you're like, oh, okay, this is where my score is. And then you get there and it's lower. Well, the reason being is because there's many different scoring things, right? There's Vantage score, for instance. And lenders also may look at your merge score, which is the average of all three of the major credit reporting bureaus, which is Experian, TransUnion, and Equifax. And that's what these monitoring companies do. They kind of give you the average um, of what your score is. Lenders and others may also look at specific scorings for things like when you're buying a house or other credit things, right? They kind of look at this matrix to get a composite score for you, right? Usually what they're going to do is they're going to take your score from multiple locations and then add them up together and divide them themselves because they're looking at different things. So your credit score is the most important though, and having a good FICO score is a really great place to go. Now, it is important to check your score at minimum annually. But the great news is if you have a loan or a line of credit or a credit card with LAPFCU, you can check your credit score quarterly for free on the LAPFCU app, which is really good. So how do they actually calculate those scores? Let's take a look at that real quick. By knowing your numbers, you're going to know where you're sitting at, right? 10% of your credit score is new credit. You know, those inquiry minds want to know. So you really want to limit how many new credits you're going out for, right? 3 is the maximum in a period of time in 90 days. So you really want to keep that new credit low because if you get new credit, that new credit is going to bring your score down a little bit and then it's going to start going up as you pay it on time. But if you get a whole bunch of inquiries and nobody lended to you, yeah, that might hurt your score a little bit. So it's 10% of your credit score. Now, 15% is the length of your credit history. Okay. So what you want to do is you want to keep your oldest credit card forever. I still have my very first credit card that I got, yeah, many, many years ago. And I'm holding on to it forever. I charge one thing to it, every other month I'll charge like something to it, like gas or something, and then I pay it off just so I can keep that credit card. You want to keep your credit card or the longest credit history you want, okay? It's 15%. 10% is the type of credit you use. You want both revolving, which is like credit cards, and installment, which is like a loan, right? So revolving is something that you get a limit that you can go on. Line of credits have it, where you can fluctuate up and down. You pay it and you can still use it because you've got a limit you can use. Whereas the installment is you borrow a set amount of money and you got to pay it back. Okay, so you want to have both. Now, 30% is the amount you owe. So what you want to do is you want to add up all the limits on your revolving debt and then divide it by 30. You want to make sure you're below 30% of usage because the more above 30%, the lower your score goes. The more below 30%, the lower your score goes. And of course, the biggest piece of the pie is, of course, payment history at 35%, paying on time. If you're not paying your bills on time, it's now time to start working on it, right? Start by calling your creditors to get back on track again. Now, bad credit can stay on your credit report for 7 years, most bad credit, okay? But what you want to do is, as you're making those payments on time, your score is going to start climbing up. Okay. You don't have to wait 7 years for that 30-day derogatory to go away or 90-day or whatever it is. It's when you start paying on time, you're going to actually start improving your score right away. So just start paying them on time. Get yourself back on track again. So here are the 4 steps you need to do to start and improve your credit. Again, you want to keep your balances low on your credit cards, pay off debt rather than moving it around. I can't pay this one, so I'll use that one to pay this one, and I'm moving it around from credit card to credit card. No. You don't want to do that. Rather than continuing to constantly move the debt around, it will likely be more effective to focus your energy on paying down the balances instead. Okay. So pay those balances down slowly. Of course, don't close unused credit cards as a short-term strategy to raise your score, right? Closing accounts actually may hurt your credit score. One, because you might be closing that longevity of your credit score, the 15%, right? The other thing is that your income to debt, right? You're sitting here, not income to debt, excuse me, but the amount that you're using, the limit is going to go away, and the other ones may be higher, and then suddenly you're over 30% of usage and your credit score is going to drop. So you really want to be careful when you're closing credit cards, okay? And of course, don't open a number of new credit cards that you really don't need just to increase your available credit, okay? It's recommended to have between 2 to 4 credit cards. But it's also important to only have the amount you need, okay? I do have 2 credit cards. I have one that I use for my medical and anything that's tax deductible, and the other one I use for gasoline and groceries, and then of course I come home and pay them, right? So 2 credit cards is all I have, but 2 to 4 is probably the maximum. 4 is the maximum you should really have, right? Because you don't want to get in that situation where you have too much available credit, which actually can seem to a lot of creditors as a risk. So it's actually a potential risk to lenders, right? And then maybe concern that you might be filing bankruptcy or something else might be going on, okay? So be careful there. It's also important to note that repairing bad credit, it's a bit like losing weight, right? It takes time, and there's no quick way to fix a credit score. In fact, out of all the ways to improve a credit score, a quick fix effort really backfires in most cases. So I want you to really be aware of any advice or claims from organizations out there that say, I'm going to fix your credit score. We're going to get rid of all the negative on your credit. No, don't do that, because what's going to happen is if it's legitimate, it's going to go right back on your credit again. Okay. So the best advice for rebuilding credit is to manage it responsibly over time. Take one step at a time. And again, the good news is that LAPFCU does partner with Balance. And we do have free, confidential, certified coaches to assist you in improving your credit and strategies to delete your debt as well. Here's a few tips to get out of debt, okay? Write down your debt. That's like that's to me the best thing on this list is make a list. Okay. This is going to help you to own your debt. When you write it down, you see it and you say, yep, I did it, right? You end up owning it. Write down how much you owe. What is the minimum payment? Okay. Have everything written out in front of you. It really is the key to success. It really is. That's the first thing I did a long time ago is I wrote it down and I looked down and went, okay, just like losing weight. Once you see it, you're like, okay, I'm going to do something about this, right? The next thing you want to do is you want to lower your rates, okay? So you can lower your rates just by contacting your creditors. If you've paid them on time, some of them will go ahead and lower the rate for you. Paying high interest rate really does take longer to pay off, as most of your payments will be going to interest, right? You may be able to lower your interest rate as well by calling LAPFCU. It's always a great place to start, right? They actually have really great consolidation loans that will really help you. So you can actually put them all into one payment. But if you do that, I implore you, it doesn't mean you can kind of build up that bad credit again. Okay. You don't want to build up those credit cards again. I had a friend who actually consolidated really good, nice payment, less payment than paying individually to all of the credit cards and debt that they had. It was one simple little payment, but then they charged everything up again and got worse shape. Okay. So really make sure you control the spending at that point. Okay. You want to really be comfortable meeting other obligations, right? The other thing you want to do is you want to monitor and adjust. Once your plan is set, you may need to adjust it a little bit. Make sure you're making progress. And you'll always want to make adjustments when necessary. So monitor your credit score each quarter to see if your credit score is improving over time. As your credit score improves, if you weren't able to consolidate before, reconsider that consolidation loan or a balance transfer to save money on interest. Make sure if you do consolidate that the interest rate is less than the average rate of what you are consolidating. Again, LAPFCU, they're there to help you with the refinancing or other debt consolidations for lower rates and possibly a lower monthly payment, which is really cool. Now we're going to talk about plan. The last one, spend, save, borrow, and plan. When it comes to life, nothing is certain. Life happens, as they say, right? We cannot stop things from happening. Get a flat tire, maybe an illness. Like me, I dropped my smartphone in some water, right? A windstorm that damages your roof. We can, however, give ourselves protection by having insurance like life insurance, auto and home insurance, rental insurance, disability insurance. But once you get them, you want to check on them on a regular basis just to make sure you still have enough. Purchasing the right insurance is always determined by your specific situation. So it's really important to get an unbiased advice from a licensed advisor. Again, you can get that help with LAPFCU with their financial planning and investment services. Planning ahead for expenses like the holidays, retirement are also really good too, or a new roof, right? Starting with budgeting those future expenses into your spending and savings plan is also going to help you. And again, that emergency savings account is the best way to start, okay? It's going to help you be in the driver's seat. It's going to help you take, of course, control of your money versus your money taking control of you. That's one of my favorite sayings. That's why you hear me say it quite a bit, okay? Now, I know we covered a whole lot of stuff here tonight. Um, and yes, financial health is a journey, and it isn't something that you can change overnight, but you need those tools. It's a journey that develops throughout your life. Having those tools, taking those little baby steps is what's going to happen to help you be financially healthy. Remember, financial health has nothing to do with how much money you make, but rather the most of every dollar. Again, take those baby steps. Maybe start with creating that budget, right? That spending and savings plan, right? Maybe start putting maybe $5 into a savings account each month. Maybe contribute to your retirement plan if you're not already doing that, or maybe upping that retirement plan. The main thing is you want to see it, believe it, and you will achieve it. So I am going to bring back Carla. Are you there, Carla?
I am here. Thank you so much, Colleen. So, here are some resources for you guys. With the credit union, we have lapfcu.org that you can find so many beneficial resources, calculators, information about rates, just to definitely compare what rates you currently have to see if we can go ahead and help you to refinance. Also, we do have Balance, and Balance is our financial partner and education and coaching. And you can actually reach out to them, lapfcu.balancepro.org, and they can help you create a budget and give you more educational tips and coach you through being able to look at where you're at currently with your finances and give you some tips to uh, just financial well-being. Also, we have the Consumer Financial Protection Bureau, where you can go ahead and go into consumerfinance.gov, and they can go ahead and also give you some great tips about credit, and of course our free credit report, annualcreditreport.com, that you can go ahead and actually get your free credit score at any time now, actually, online. And you can go ahead and look at what is reporting and how we can go ahead and help you with your credit as well. Okay, but thank you so much again for joining us this evening. Also, thank you so much to Colleen from Balance for the invaluable money savings tips. I hope you found some helpful information into what it means to be financially healthy and how to make actionable steps towards achieving your financial goals. Remember, it is not just about knowledge, it's about putting that knowledge into practice. As you move forward, do not forget to make use of the powerful tools available to you at lapfcu.org, and also your online banking. From budgeting tools to easy access to your accounts and resources, we're here to help you and support you every step of the way on your journey to financial wellness. If you have any further questions or need assistance, do not hesitate to reach out to us. We are here to help you. And thank you once again for being part of today's session. And I wish you all a best in your financial journey.
And
Thank you
if you
so
don't mind,
much.
Carla, we do have a question here, and that's on the handouts.
Of course.
Were these handouts in the email as an attachment or something? No, they're not. So just to let you know, if you did not get the handouts are, if you look at your little thing on the sidebar there, you'll see a little thing that looks like a piece of paper, and there's a little paper clip attached to it. Go ahead and click on that, and the handouts are there. So that way you can get your handouts. And if you can't find it, just put it in the question box and we will make sure that we do email them to you. Okay. So if you can't find them, we'll get them to you. All right. Does anybody else have any other questions before we log out? Okay. Well, again, thank you again, Carla. And I really appreciate being here with you guys. And I hope again that you learned at least one thing. And I hope you have a wonderful and joyous evening.
Thank you, everyone. Have a great evening. Bye bye.